The big picture is that the Japanese government has spent a lot of money over the years. The bond market is saying, wait a minute, there's going to be more financing.
The challenge for her is how to push forth her economic and security agenda while addressing cost of living issues that will obviously put a lot of pressure on debt.
Turmoil in the bond markets, recent lows in the yen, and a snap election to boot. Let's take a look at what's going on in Japan. Trin Nguyen is an analyst with Natixis, and she joins me for more. Trin, welcome. Just to be clear, the announcements of snap elections seem to actually usher in the latest fiscal turmoil, but we know that borrowing markets have been jittery in Japan for a while. Before we get into this latest episode, can you just give us the big picture of what's happening in that country when it comes to fiscal policy and concerns?
The big picture is that the Japanese government has spent a lot of money over the years, so they have quite a big stock of government debt, which has been no problem as long as you can fund it very cheap. The second part is that we have the prime minister who's new, and she's going to call a snap election that's likely to cement her ability to push through a bigger spending, right? And as a result, the bond market is saying, wait a minute, there's going to be more financing, which means the Japanese are going to have to borrow more in the markets. And more important, what she's doing is also providing more spending to stimulate growth, which means growth is going to be quite strong. So in that environment, the yen itself has weakened and the bond yields have risen across the curve. And that has huge implications, not just for Japan in terms of what that means, in terms of what they need to do, because Japanese yen is no longer being weak is no longer good for Japan because they import quite a lot. So the pass through to inflation means that people are not very happy, right? The costs are going up, a very similar situation as Europe. So as a result, the government itself cares about the yen and that doesn't want it to be so weak. But at the same time, it has these policies that are pushing the curve in a certain direction, which means for the central bank of Japan, they have to ultimately hike interest rates if they want the yen itself to not be so weak. But at the same time, they also don't want to do that because we not only have a big stock of debt, but also we have more fiscal spending, which means they need to be able to fund it cheaply, right? So it's in a dilemma. And that has huge implications for Europe, the US, and the rest of the world.
Okay, let's break that apart just a little bit. What we saw last week with the turmoil in the bond market, put that into perspective for us from what we've seen in recent months. For example, since Prime Minister Sanae Takaichi came to office, we have seen these jitters. How bad was it last week compared to what we've seen before?
So it's steepened quite significantly. In layman terms, it means that in the longer end of the curve, with the government borrowing long terms, 20, 30 year, it moved very sharply. It moved sharply because investors want to be paid more for the debt. And that sharp move in the yen actually has impacted the rest of the world because the Japanese traditionally have invested offshore outside of Japan because they have such a low yield and low growth onshore. So they have funded, for example, US government debt, US equities. They have funded European government debt and European equities, and also the rest of the emerging markets, countries such as India, that traditionally offers very high yield and high growth in order to attract Japanese investors. Now, the rise of the Japanese bonds yields have actually impacted and percolated globally, right? Because in Europe, you have a huge fiscal spending in Europe and the US as well. And these Japanese investors, given the rise of the yields or the higher return they can get onshore, are likely to be much shyer in investing offshore, right? So you see bond yields rising in Europe, you see bond yields rising in the US as well. And most importantly, for countries like India that need Japanese investors, seeing also high bond yields, right? So I think that has a big impact globally. And therefore, what happens there is very important for global assets.
We see now this new effort to support the yen. Can you tell us what we saw today, Mondays when we're recording this, that has caused actually the yen to strengthen a bit from where it was?
Right. So the BOJ held interest rates, but it was very hawkish hold. And after that, you have interventions, and also not only that, you have the prime minister and also support from the US as well. So there's the market itself coinciding with the fact that we also have a sell dollar story where the euro appreciated and a lot of developed Asian FX has appreciated. So we have this anticipation and the rise of the JPY. And I think that is also quite important in terms of impact as well. Because if the yen is allowed to increase in terms of appreciate vis-a-vis the dollar and other FX, that's an indication that not only we have bond yields rising, and given how cheap the yen is, its appreciation will also gives another reason for Japanese investors to stay at home.
How sustainable is that strengthening yen when the long-term trend seems to be more and more borrowing on already significant debt? As you said, that's the overarching sort of umbrella concern that a lot of investors have. How long are we going to see the strengthening of the yen?
Absolutely, which is one of the reasons why the markets expect the BOJ fundamentally will have to raise the short end of the interest rate, which is the overnight rate, right? It's currently at 0.75%. And fundamentally, if you look at the yield curve, it's steepening over time. So it means that the markets expect the interest rates will have to rise to meet inflation and also higher costs, which means that the markets expect that nominal growth in Japan will rise, right? And so that in itself means that the interventions are just a short-term reprieve, and fundamentally the BOJ will need to hike interest rates.
You touched on this before when you talked about a softer dollar, but how important is the Federal Reserve decision, I believe, this week for Japan as it looks at what it's doing going ahead?
Absolutely. The key reason for Japanese JPY weakness is the fact that the dollar itself is very, interest rates on that continues to be very high, right? Markets expect the Fed to keep rates on hold. Now, obviously, the forward guidance is going to be quite important. Markets will look at also Supreme Court decisions regarding Lisa Cook for Fed independence, so risk premium for U.S. assets. Fundamentally, we think the Fed will cut rates. When the Fed does cut rates, and it's going to be much delayed until March, and it's going to be very gradual in cutting, that's going to provide a lot of respite for the yen. So in other words, the BOJ is also waiting for the Fed to cut rates. And for now, it has to use interventions to support it. But once the Fed cut rates, that would alleviate a lot of pressure. And as we have the Fed cutting rates and the BOJ raising rates eventually, and we don't think that's going to happen until the end of second half, if not in July, then therefore we're still going to have appreciation of the yen driven by both softer dollar, the Fed cutting rates, and also the BOJ hiking rates.
With the BOJ pushing off rate hikes right now, the Fed, as you said, waiting as well, most likely. There's still a lot of space between now and then when those two things converge, as you said, and we start to see movement in a direction that the government would consider positive. Is there a potential of crisis, of something spiraling out of control if the bond markets enter into this kind of spiral again?
We don't think that is going to happen. I do think that at the moment, given the softness of the dollar, that is provide some respite for JPY. Investors are looking for diversification, right? They're looking for, when they look for diversification out of U.S. Treasury, there aren't so many comparable assets in which they would invest, right? In terms of high quality with a lot of good liquidity and volume. And I do think that JGBs and the yen being, even after strengthening quite significantly since the intervention, is still very relatively cheap. So as a result, if they allow for some appreciation expectations, I think for investors that's worth taking a look at. And I do think that they will benefit from the diversification trade, just as Europe has, right? If you want to diversify our U.S. Treasury, unless you want to go up the risk curve and go into Indonesia or some other emerging markets, you do have to look at developed markets. And as a result, if you see the winners of diversification have been very much more developed, higher rated developed markets, as well within Asia, countries like Malaysia, Singapore, South Korea, Japan, for example. And so as a result, I do think that the BJ is getting some support from this sell dollar story.
All right, that's Trinh Nguyen at Natixis. Trinh, thank you so much.
Thank you for having us.
All right, William Chu joins me now from the Hudson Institute for more. William, welcome. We know that Japan has a lot of debt and that it's built that up over decades. Why exactly is that? Help us understand why this debt load compared to GDP is so significant in Japan, especially compared to pretty much any other country in the world, I believe.
Yeah, Stephen, great to be here. So Japan's government debt is some of the highest in the world. It's about 230% of its GDP. I think there's a lot of factors, right? Some of it is because of its shrinking and aging population, which puts a lot of stress on social services and dampens investment. At the same time, Japan traditionally has had a high savings rate, which eats at consumption-related growth, and much of this savings is going into savings rather than in investment. So all of these things are playing a factor into Japan's sort of high debt load, and that's before we even talk about the current government's plans to increase defense spending and also economic investment.
And that's exactly what I wanted to ask you about. When we look at this new government, is it just coming into an environment that was already concerned about Japan's debt load and then sort of adding fuel to that fire? Or is it the origin of a lot of these jitters? Help us understand what came before and what's because of this government and its policies.
Sure. So certainly there's a lot of structural factors, right? As I mentioned, Japan already has a really high government debt load as well as a structural, situation with its demographics. That said, the Takaichi government has come in and prioritized three things: cost of living concerns, trying to drive economic growth and innovation, and also defense spending. All three of these things require some kind of increased spending, or either through taxes and bonds or cutting social spending. And these created a complicated situation in which putting a lot of pressure on long-term Japanese debt because there is the expectation that Japanese spending will be going up. At the same time, it's also coming into a challenging geopolitical environment, as we see from Chinese economic coercion and also political coercion against Japan over Taiwan issue, where Japan does need to do all three of these things at once. And so that's creating a lot of tension.
We saw last week that there was a big bond sell-off after Prime Minister Sanae Takaichi called for snap elections. Why did that create such a panic in the bond market?
Sure. Well, so the current government, right, is led by the LDP party and also the Ishin party, and they don't currently have a majority in the Diet. The prime minister is personally very popular, but her plans, which address increased defense spending, economic investment, cuts to the consumption tax, and also cutting the number of seats in the lower house in the Diet, are all going to be very challenging, right? So this is why she's called for a snap election. Combined with her long-term economic plans, which she sees as a necessary driver to drive Japanese economic growth long term and put it on stable footing. That I think is driving some of the movement in the bond market. So it's somewhat related to the snap elections, but it's also related to some structural factors as well as geopolitical realities.
The yen has been especially weak, which the Japan government at one time seemed to like. It doesn't like that as much anymore. It looks like Takaichi's popularity has suffered under inflation as a result of the weak yen. Is that fair to say? Can you sort of take us through it?
Yeah, I would say that her popularity is still extremely high, right? I think it just went below 70%, which is the first time since she came into office in October. I would say that I think inflation has been a persistent situation in Japan since COVID. It's been consistently much higher than what Japanese people are used to, although these are numbers that I think many of us in the West would actually really embrace. That said, I think the challenge of her is to how to drive push forth her economic and security agenda while addressing cost of living issues that will obviously put a lot of pressure on debt, and also in terms of addressing sort of the movement in terms of the yen. And I think the government actually does not want a weak yen long term. They want a stable yen. But I think that will take a lot of work at a time when there's a lot of structural impediments that are making it more difficult.
And that was what I wanted to ask was, has the government truly figured out if it wants a strong or a weak yen? You would say a stable yen.
Yeah, I think generally the conversations when I've talked to senior government officials is that they're looking for something in the sort of the 135, 140 range. And I think, there's been a lot of claims that Japan has been manipulating its currency to make it weak so that it can promote exports. But given that a weak yen is actually hurting Japan in terms of driving up costs for ordinary Japanese, and that's creating real political implications, right? The last government fell because of these higher costs of living. I think any claims that Japan is purposely trying to weaken the yen so it can drive exports is not based on fact. Rather, what the Japanese government want is a stable yen around 135, 140 to the dollar, is to allow for them to make these long-term plans that they believe that they need to do in order to ensure Japan's long-term economic viability.
William, the yen is one of the world's major currencies. It plays a major role across the globe. At the same time, we see that borrowing costs are rising for a country that has a tremendous amount of debt. How worried should we be in the middle to long term about Japan's situation?
I think it's definitely worth worrying, right? The fact that long-term yields are up to 4% plus. I mean, traditionally, the Japan has had really low cost of borrowing, which has made it very attractive as a place to borrow money from, and also seen as a very stable market. Now, this volatility, in part driven by the government's plans, as well as geopolitical realities, as well as structural factors, it's definitely creating some concern. That said, I would say that the government sees these structural factors as inevitable, and so in order to address them and to sort of overcome them, it has to sort of roll the dice on encouraging economic innovation and defense spending, creating a virtuous cycle of defense spending and economic growth long term to sort of put the Japanese economy on a more stable footing long term.
All right, that's William Chu from the Hudson Institute. William, thank you so much.